Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Thursday, January 30th, 2020. My name is Will Pauly and I'm here with my co-host, David Blake. David, how are you doing today?
Good, Will. Thanks for asking.
All right, let's start off with a peek at what the market's been doing this past week with a look at the market letter. Can you give us a quick breakdown of what we're seeing here?
Yeah, we had a little bit of a crack in the market last week. We came in, we had some concerns that were coming up with this coronavirus over in China. That caused the market to sell off a little bit last week. The Dow was down about 1.2%. The S&P fell about 1%. We had the NASDAQ actually snap a 6-week win streak. So we had a little bit of selling, despite some better than expected earnings. They're coming in so far mixed. Last week on Dow components, Intel, Procter & Gamble, American Express had some blowout earnings. Then this week we've had, I believe, Apple came in today. Last night we had Microsoft. We've had Tesla come in, but underneath these big cap tech earnings, we're having a much more lackluster earnings period than what the headlines are grabbing. So last week we did see some technical deterioration, which was actually not unexpected. We had such a parabolic move in the major averages going into last week that we were due for some consolidation. Now, on one day last week, we did see the transportation index bounce off its 50-day moving average. I think that was on Thursday. It did find support there, but then we've broken it this week, which is a negative divergence. We also saw the Russell 2000 underperformed the broader market, which is negative divergence. It was down 2.2% last week, and it's leading the market down again this week, and we're trading right now once again below the 50-day moving average on the 200. As of this morning, we actually are getting the Philadelphia Semiconductor approaching the 50-day moving average, and I think it's around 1830 this morning. If that would break 1813, which is the 50-day moving average, that's probably going to induce some more selling in the market. We're starting to see some of these big cap tech stocks that are beating on earnings actually sell off after they get a pop, and then they're coming back down. We saw that with AMD, which had a nice quarter earnings, but they were a little bit light on their guidance. Part of that is due to this virus because we're not sure exactly how much it's going to affect the first quarter. Looking here at some of the different sectors that we saw during this week, which I want to get into a little bit more of this week because we're already due on Thursday. But some of the other sectors that we're seeing, we've already had, as of right now, we have the XLF, which is the financial sector, trading below the 50-day moving average. Part of that is because you're seeing the yields come down. You're seeing a narrowing of the yield curve. And in fact, we're getting close to being almost flat on the yield curve between the 30-year and the 10-year and the 3 months. So we want to keep an eye on that. As of this morning, we've seen weakness in the healthcare, industrials, and consumer discretionary sectors. And those are actually trading right down to the 50-day moving average. So a break below that on any of these would be a negative for the broader market. Facebook last night came up a little bit short on their earnings report, and that showed the communication services sector, XLC, coming down near the 50-day moving average. So a lot of these are getting down to a point where we're expecting them to hopefully find support. But if they don't, we could see some secondary targets being hit that we mentioned last week in the Schwab market letter. And we have the XLE energy sectors already below the 200, and today we've got the XLB, the materials sector, also falling below the 100-day moving average. We also saw some strength in the U.S. dollar last week, which is hurting commodities and but helping out some of the high dividend and high utility sectors. The utility index, in fact, is up 6.1% year to date. That's showing a move towards safety. You've also seen buying in gold, which is making a 52-week high. We're seeing that up around 1580. Again, just a little flight to safety while we're seeing what's going to happen with the coronavirus and that type of thing. Going further, I want to look at the sentiment. Going into Friday, the sentiment index was a -5, which I wrote in the letter that it's a little bit just too frothy as far as people being too bullish. We had the percentage of investment advisors up around 59.4. Anything above 55 is going to be a little bit bearish. Percentage of bearish investment advisors are still down around 17. We saw that jump up this week to 18 something, so that's coming off, getting a little bit more neutral. In fact, the ratio between bulls and bears on the advisors is back to neutral. That helped. VIX, we saw that spike up to about 18 the other day. Not sure what it is today, but that's back up in the neutral ground. And a lot of times, we did see the VIX pop up about 25% on, I guess it was Monday or Tuesday when we had the big sell-off. Usually when you get a 25% jump in the VIX, that'll represent a minor. That can represent a minor support level, and we did see the market bounce back on Tuesday a little bit, and we got some follow through on Wednesday until the last hour. And then we saw that come back down to finish mixed, and we're getting again, we're down about 200 points right now. What I would like to see, I'd like to see the VIX get up to around 25, 20 somewhere in that area, even if it's just temporarily, just for a spike during the day. That usually will signify that we've gotten enough fear in the market that you'll see buyers coming in off the sidelines. So I want to see that get up at least in the low 20s to see if we're going to. These put in a temporary bottom in here. Okay, last week on the Schwab letter, we got I put out first support levels for the Dow Jones at 28.5. As we come in this morning, we're actually we were at 28.540. We did hit went below 28.5 on Monday. For the S&P 500, I put the initial downside support level will be 32.25. We've gotten down to 32.40. On that, so we're close to that. If we would break that 32.25 level, that sets up a possibility of 31.50 for the S&P 500. Not sure it would get down there. I know there's some more support around 31.90. The Nasdaq, I think, due to the big cap tech stocks, I see support level at about 9,000. If we would get a more broader selling, we could go down to an 8,800 for a secondary target. But for right now, I'm not sure we're even going to get that low. One thing that did bother me is when you turn on the TV, every single analyst out there was calling for a 5, 6, or 7% pullback. And that's a little bit of a red flag to me, meaning that if everyone's calling for that much of a pullback, it may not even be that much. So we may be in the throes right now of as far as what we're going to see on the downside. But keep an eye on those levels that we just talked about, especially at 2,800 or 28,000 for the Dow and that 32.25 for the S&P 500 is areas that we'd want to, keep an eye on, because if they get broken, then we actually could see a little bit more intensive selling going on.
Well, the market snapped back pretty quickly after the scare we had on Monday. Is that it for a pullback? I know the Dow and S&P hit your initial downside targets. So is that it for now, or is there more pain on the horizon?
Well, I think in my mind there is a little bit more pain in the market. I don't think it's going to be something where we see a 10-12% correction coming up. Obviously, the wild card is whether or not we see this coronavirus expand out and cause more death. It certainly is causing some problems in China. I did want to note, I mentioned it last week, that the Chinese market is actually closed this week. It opens up on Monday, and you want to kind of keep an eye on that. There's apparently the Chinese economy does slow down during their week-long New Year's celebration. However, this year is going to be really actually they think they could actually hit their economy for 1.5% percentage points in growth. And if we start to see more of this outbreak, more deaths and more spreading into other countries, it could actually induce more selling. Now they open up on Monday. On Monday or Tuesday of this past week, we actually saw the Shanghai futures down about 6 or 7%. If you go, you can even go on Yahoo Finance over the weekend, and you'll get an indication of where the Chinese market is set to open on Monday. If we would see a 10 or 12% drop in that market to start next week, we will probably hit our secondary targets here on our Dow. I think that would be, if those levels hold, I think that you could actually wade into the market and pick up some stocks. Now, one of the things we've got a nice pullback on, KWEB is an ETF of the Chinese internet stocks. It's in my portfolio of sector industry groups, which we came out of around 52. It's trading right around 48. If that would get down between 44 and 46, I think that would be a buy for somebody looking to get involved with the Alibaba and the JD.com, that type of stock. And it might be a way to play the bounce back in the Chinese market if we do have a big 10-12% correction in that. So there's some different things to watch. Also, as I mentioned with some of these sectors, okay, we've got the XLF, the XLE, and XLB, materials, energy, and financials, already below the 50 and 100 and 200 day. Keep an eye on XLV, and XLI, and XLY. They're trading today right on their 50-day moving average. You can go into the smart chart on our site and take a look at that, or any charting package, and take a look at those. If they start to trade and close below the 50-day moving average, that also would be an indication that institutional money is looking for further downside on that, and you're starting to take out support levels, and that could open it up to the secondary level that we talked about earlier in the webinar here. So to wrap it up, I do think we could still see some more downside. Again, the market hates unknowns, and there's still a little bit of unknown with this coronavirus. That is the wild card that if it spreads, it could induce some temporary, broader selling. I'm hoping that it doesn't. We certainly don't want to see anything like that affect, the global economies or the country itself. So, just at this point, I would still be kind of cautious. I'd have a list of stocks that I would like to buy. Maybe look at Intel or some of the semiconductors if it gets down. If we start to have a breakdown, because I think they'll do fine going forward. Technology is still leading this market. You might even look at the XLC, the communication services, as a way to possibly get involved back with Facebook if it finds support down here around 50-day moving average. But for right now, I do think you just remain a little bit cautious and have that list of stocks that you would like to own if the market does have a sell-off. Because if we go down and we find support at these levels that we talked about earlier, I think you'll see more institutional buying coming back into the market, and it could give you a chance to enjoy some decent gains going forward.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered in the next Tech Talk, you can email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tech Talk. Thank you for tuning in, and we'll see you next week.